Well, good evening, everybody, and welcome to the roundtable for February 2022. We're going to be presenting our Golden Knight Awards for the year 2022. This is February 2023,
Gonna
by the
say, that's
way.
like writing a check
Yeah,
going.
and I have in the back room with me tonight Lynch from Atlanta, Mark Robertson from Rochester Hills, Michigan, and we're joined with one of our Mid-Michigan directors, Herb Lemkohl, who splits his time between Traverse City, Michigan and Southern Florida. We'll be trying to stay with you as you ask questions and keep us busy this evening, but we promise to have a lot to talk about and a lot to get through. So without further ado, I'm going to introduce to you the people on the front slide, because these are our knights and damsels that help us keep this program moving, and we've been moving this program along now for 13 years. That's Candace Baker off to your extreme left as you're looking at the slide. Candace is from the St. Louis area, and she's been with us once or twice in the last few years. Many of you recognize Kim Butcher, who's second in line. Third is Kevin Galagli from the Metro Washington area. He's actually a member of the Maryland chapter. He lives in the northern suburbs of Washington. And Kevin has been a guest of ours now a couple of times. That's me, followed by that distinguished white-haired gentleman. That's Herb, right smack dab in the middle of the group. Lynch is next, and then our friend Ann Manning from Houston. Ann joined us at convention last year, in June of last year, and did just a wonderful job in going live with the roundtable down in Dallas. Next, we have our friend from Pasadena, that's Hugh McManus. And then followed by a very dapper, I think he's in a Halloween costume, though. I don't think that's the way he normally dresses, but a very dapper Mark Robertson.
Stay
Finally,
tuned.
stay tuned, okay. And then finally, that's Matt Spielman. Matt used to be a Mid-Michigan person, was in one of my investment clubs, in fact. And then when he retired from his job up here, he moved his family down to the Houston area. Matt is a real plus to any group that he's a part of, and we're glad to have him working with us on an occasional basis. This is the Golden Knight Awards, and it's just a lot of fun to look back on the kinds of things we've been doing for the last 13 years, give some recognitions to some of the people that do a lot of work. It's all volunteer work, and obviously it's something that people enjoy doing, or they wouldn't continue doing it. Let's go to the next slide if we can, Mark.
I just wanted to make it clear that we are not sponsored by Portillo's hot dogs, but we should be.
This is an educational demonstration. Everything we do this evening is for educational purposes. We are going to be talking about real-time companies in real time, and we're probably going to try to let you know when we own a company and when we have a particular stake at risk in one of the things we're talking about. But we do ask you not to go out and make any purchases or any sales based on our recommendations or based on our commentary. Please do your own homework, draw your own conclusions. This is something that we've been doing for a long time. We have a great deal of fun doing it, but the whole purpose of the exercise is to have you become an independent stock analyst and be able to manage your own portfolio and make your own stock decisions. If you are new to the group and did not get a reminder about this meeting, but rather got a link from somebody else to get here this evening, and if you'd like to receive links to the roundtable going forward, drop an email to Kavula1, that's my wife, at Comcast.net, and Natalie will add you to our guest list and make sure that you get a reminder about each roundtable as they come up. Most of the time we run them on the last Tuesday of the month, but there are occasions when we move back or forward a Tuesday, depending on what's happening on the calendar and in our own personal lives. If you'd like a copy of the slides that we're going to present this evening, you can email Mark R at manifestinvesting.com. And if you would like to engage either one of us in questions about the program, there's the email addresses for Mark and for myself. We do try to answer your emails, but give us a little bit of time sometimes, folks. Again, I'm reminding everybody that the work we do for this program is a labor of love. It's volunteer work, and we try to stay current on it, and we try to be very serious about it, but at the same time, it offers us recreation and a lot of good, clean fellowship with people that are like-minded individuals. We also have our YouTube channel. You can go to Manifest Investing Roundtable, or you can just Google Stock Roundtable, and you'll come to our channel. We'd love for you to subscribe to our YouTube channel, and that's where we post all of not only the roundtables, but all of the bull session programs. Mark and I run a bull session program every Tuesday at 2 o'clock in the afternoon. We'd be glad to have you come. If you need more information on that, drop an email to Mark or to myself. Next slide, Mark. We have a standing agenda, and it's pretty much the same every single time. We haven't varied very much in all the years we've been doing this. We leave an open part of the meeting at the beginning for true discussion and for the presentation of a program. We always check the scoreboards, and we're going to be doing that again this evening. We look for stocks that we might want to sell out of the portfolio. That's a regular part of the process. We know that selling is as important sometimes as buying, and we don't forget that there are sometimes stocks that need to be moved out of the portfolio. And then we'll give you 3 really good stock picks. Tonight, Cy is going to speak about Domino's Pizza. I'm going to speak about Western Alliance Bancorp, and Mark is going to speak about Williams-Sonoma. We'll take an audience poll, and then we'll leave the mic open for audience questions and answers. Next slide, Mark. This demonstration is something that 13 years ago, Mark sat down with me, and the two of us said to each other, we'd like to do a demonstration. We'd like to keep score, and we'd like to do it with some of our friends. And somehow we convinced Cy Lynch and Hugh McManus to join us, and the 4 of us began the round table. Basically, the idea was for us to each pick a stock once a month. It evolved a little bit later into adding an audience choice to that whole process. So today we each pick a stock and add $1,000 in imaginary money to the portfolio. And then we take a poll asking the audience what's the best stock that we've presented this evening. And the winner of that poll gets an extra $1,000 added into the portfolio. We're trying to identify a single favorite actionable investment opportunity. We're looking for a stock that we think is in the buy zone and would greatly complement the portfolio itself. We try to keep track of our core holdings and our non-core holdings, and mimicking the teachings of George Nicholson, we like to hold our non-core selections to less than a quarter of the portfolio. You all know what core stocks look like. They're up straight and parallel. They match the model in a beautiful, beautiful way. Good, strong, consistent growth in sales and earnings. Well, non-core selections are selections that don't fit that model, but for various reasons we think might have a place in the portfolio. Our goal is to beat the market. And we'd like to beat the market by George Nicholson's stated goal, which we think if he would be around with computers, he would have stated that goal as try to beat the market by 5 points. So we're looking to beat at any moment that the market's in action. We'd like to have a return that's 5 points better than what the market is doing. And we're going to define the market as the Wilshire 5000 stock index. So that's our benchmark that we'll use to see how many points we're ahead or behind the market. That little bit of ahead of the market or behind the market is called our relative return. So if the market returns 10 and our portfolios return 12, our relative return is 2%, and we keep track of that relative return, and we report it to you on a monthly basis. We'd also like to have an accuracy rating of about 60%. I think right now we're running better than 50, but not quite at 60 in our accuracy. But we'd like to make sure that at least 60% of our holdings match these goals that we've set for this demonstration. This is a tracking portfolio, so it contains many, many more stocks than you would put into a normal nest egg kind of a portfolio. But the process about maintaining that portfolio is pretty much the same, and we'll go over various pieces of it at various times throughout the year, trying to teach as well as to entertain a little bit. Let's go to our next slide and see where we're at, Mark. So again, welcome to the 2022 Roundtable Golden Knight Awards. I warmed you all up, and I was the opening act for my good friend, my dear friend, Mark Robertson, who's going to be our master of ceremonies. I'll tell you, he's dressed in something akin to that yellow suit that you saw him in on the front page right there, and he's getting ready to broach whatever goes on. I can assure you that there'll be nobody rushing from the audience to punch somebody else in the nose. All right, so with that in mind, Mark, take it away, Mark, okay?
That's good stuff. All right, well, welcome to the awards again. Silence your cell phones, but keep snapping those photos. This is what we've been doing for the last 12 or 13 years now. We basically try to give out 7 awards every year, where we're basically focusing in on the selections made over time, how well they do performance-wise, how accurate they are. We do have a special category known as Best Picture. And again, long-term performance at generating superior total returns is what we're after here. So those are the 7 awards. And I'm going to just basically do a little disclaimer up front here. Yeah, I hire the accounting team. I'm involved. The accounting team's in our conference room eating pizza and counting down the groundhog results and the red carpet results and the golden statues and all that. But
Domino's pizza, right?
Yeah, it is Domino's pizza. I just wanted to disclaim up front that I had no influence over the selection made by the accounting team and the golden envelopes.
Okay, you're protesting too much now, Mark. Keep going. All right.
All right, so here we go. We've actually we featured the best selection made in any given year, and I am back with another golden statue for the 2nd year in a row. I had a good year, guys. That's a little foreshadowing. You can see the selections made by the team down at the bottom over the course of 2022. And again, we go back about the last 15 months as we pull these out. And it was a pretty good year for Ardelyx and Green Brick, and I'm very grateful for that. Texas Roadhouse did very well, Fox Factory. And it's just interesting to look back over the years at the progression of winners. We've had quite a mixture of winners over the years. And Ken, I found it kind of interesting that there's those repeat selections on there, repeat performers. as far as the best stocks of the year. It kind of reinforces this notion of borrowing ideas, I think. You see a couple apples on there. You see a couple, what was the other one that's a repeat? Five Below. I borrowed that from Nick Strategos. And again, Ardelyx is back after being originally featured by the Irishman, Hugh McManus, back in 2018, 2019. So it was a good year for Ardelyx. We're kind of holding our breath. That is a non-core selection, but the number one position actually came from the follow-up to the Dallas National Convention that you see the slide up above here, the follow-up session that we do when we return home. And 57 cents was a pretty good entry price for Ardelyx. So the first golden statue goes to me. Any comments or questions or any standing ovation in progress?
I'm really pleased that a September choice made the top 10 here. That makes me feel real good. That Fox Factory entry in the top 10. That's only from a couple months ago.
Yeah, Fox Factory selections that you've made have done very well in general. We had a pretty good year. All right. And then here's the best selection all time. And again, I'm going to be awarded this one on the basis of that Ardelyx surge. These are actually the selections going back to the beginning of the contest and how they have done. The positions that are shaded in yellow or that could be tan on your computer are actually closed positions that have been sold. So those are locked in. The Ardelyx and Green Brick partners on this particular chart are active selections. So we could wake up tomorrow morning and Ardelyx could be $1. And that would obviously affect this chart greatly. But a little bit of retaliation there for the St. Louis Post-Dispatch treatment that I got in St. Louis with the Two Guys Talk stock.
That really struck a nerve, didn't it, Mark?
You've noticed, huh? But again, this is another category. There's some fairly interesting selections made over the years. Nick, our dear departed friend Nick, picking Five Below, and Hugh McManus and his I Want to Own a Bank, and the selection of Amazon. I can remember the Southwest Airlines stuff. Portfolio recovery was fantastic, and we've often talked about we should either have TJX in the portfolio or perhaps in it again. So some pretty good performances over time. So it's an interesting list. It takes pretty powerful performance to make this list at this point. All right, so moving right along. This is our accuracy. I actually rephrased it, highest market beat percentage. Maybe that's a March Madness thing coming out here. But the winner for the year and now all time is Ann. Ann went 3 for 3. She picked a line and at the Dallas National Convention and in the follow-up session, and also had selected Houlihan Lokey a few months before that, so she qualified for the annual selections. I did want to point out that had she stumbled, I was in position for this one too. There's quite a few pretty good selections, but Ann is now trucking along at a 70% selection market beat percentage. And I do find it kind of fascinating that all of the nights are above 50%, hovering around 50 to 60%. But Ann is now checked in at 70. You can see that category has been dominated by Hugh McManus over the years. And just a little footnote there, Kevin would like to point out that he's 2 for 2 and just warming up. All right, so we'll give Ann 2 golden statues. I don't know if Ann has anything she wants to add. She is in the audience. Outstanding presentations in Dallas in the follow-up session.
She's being her normal, modest self, Mark.
She's awfully quiet.
All right.
All right, here's our special award that we basically try to identify what we playfully call Best Picture. It can be an article, it can be a webcast, it can be the presentation of a stock. It could come from anywhere in the investing world. And it dates all the way back to an infamous presentation in 2010. But I'll tell you, it was one of the best presentations. I've never been hungrier after that, Chinese pulled pork presentation on hogs, which turned out to be somewhat of a fictional company at some point. But there's a number of fantastic presentations on here. In my opinion, Hugh's presentation on more Spock, less Kirk is just legend. It's just legend. Matt Spielman on the stroll across the parking lot for the guy who formed Air Lease, walked away from the competitor to Air Lease, walked across the parking lot and started Air Lease. So he actually recounted that, showing the footsteps in the parking lot. So there's just a number of sessions on there. Any personal favorites here, Ken?
Well, you know that I fall in love with things and then leave them to fall in love with something else. But I really have been very, very pleased with some of the newer things that we've talked about that kind of give us a few extra tools. I especially like the work that you, more than me, Mark, although you've graciously given me some credit for it. But the work that was done on the idea of prove, the projected return on value, and how it can be used as a validator of PE choices for the SSG. I thought that work, I think that was 2019. I thought that work really deserves a second or third look by a lot of folks that are with us. And of course, I have always enjoyed, since I began working in better investing, I've always enjoyed anything that we do that involves best small companies. So when we put together a list of best small companies and then brought it to a lot of people in some of our COVID cancellation conferences, I was extremely pleased. Too bad it was the 1 year out of 8 that we didn't beat the averages, and we chose to highlight it over everything else. But still, it was a great learning experience.
Long-term perspective.
Yep.
Yeah, and in terms of all-time viewership, in terms of page views and the session views, Hugh McManus's work on the FDA pipelines and the first mentions of Ardelyx back in 2018, you can see here's the slide from the program right here. Those are still on YouTube, and you can actually pull them off if you just Google them or YouTube them up, and literally thousands of views and really informative on how to hunt for a little bit less conventional opportunity amongst the pipelines. So some really good legacy programs. I still absolutely love Jim Bowen. This is Jim Bowen right here in the suit. Jim Bowen's presentation back in 2017 at the Fearless Investing Summit. And you can also find that one on YouTube if you just search any of those words. So good stuff.
So what is the 2022 winner, Mark?
Well, here are the 4 nominees.
Okay.
Again, we talked earlier about working with the St. Louis chapter on an April presentation. We're going to repeat that. Candace and I did one of the best stock presentations, best stock studies in the history of investing during that session on Generac. It just didn't work out. No, the company did not execute as Candace and I wished. And Ken, we also coupled a medium-sized company presentation as part of it. The second nominee there it speaks for itself. We've presented it a couple of times. I think it is probably one of the most mind-numbing, empowering things. You talk about taking somebody who might have a fear of making a selection, little trepidation when it comes to the stock market. In this case, we pointed out that we've made 700 roundtable selections. 200 of them have lost money. If you take the 200 and you add them all up, the amount of those losses is completely offset by just Microsoft. I mean, I get chills even just thinking about it. So that slide, that presentation is pretty powerful stuff. All right, the Beverly Hillbillies there is a fascinating series that Len Douglas has put together online on the Manifest Forum. I just started talking about Texas Pacific Land. By the way, it was the top performing Barron's roundtable selection from 2 years ago. I didn't know that until Len got cooking on this. And the depth and the amount of stuff that went into the research on this company, what it does, where it does it, how it does it, was just fascinating. And Lynn has gone into great detail. The last one there, our Groundhog Challenge was won for the second year in a row by the Space Coast Model Club in the group category, and they actually took the lead or tied for the lead on the last day of the contest for the second year in a row. So the playful banter that went on around that, plus just simply the congratulations to Space Coast, are pretty good stuff. So amongst those four candidates, we're going to pick Lynn Douglas. There's Lynn right there. I mean, the depth of research, this follows on the heels of Lynn reminding us in great detail about petroleum, and it's not just gasoline. I mean, there's a myriad of products that come out of the petrochemical industry, and I would actually put this right up there with the Jim Bowen thing. Lynn personally invested in the energy sector more than most of us would and profited pretty well from that. But again, the depth of research and looking at company reports, discussions by individuals, and again, just a number of resources, trade magazines, stuff that he brought to it, just illustrates the type of stuff that we get into. It reminded me so much of the deep discussions we had on BioReference Labs years ago. And so with that, congratulations, Len, for Best Picture 2022. Anything you'd like to add to that, Ken? Or
Well, just my congratulations to Len. He's a hard-working investor, and when Len says something is happening, you have to listen, because 99.9% of the time it's true. It's happening.
excellent job. Congratulations, Len.
Yes.
All right,
Congratulations, Lynn.
Let's go ahead and wrap up the awards. We've got two awards to go. Again, the best performance by one of our knights or damsels for a year, and yeah, I won this one too. Another slide brought to us by Portillo's. See, I not only talk about Portillo's, I actually do select it for the round table and invest in it. Pretty good series of results there. And again, this is a category that's been dominated over the years by Hugh. So kind of good to bring that one home. And again, that Generac presentation, of all the presentations I made for the roundtable in the last year, the one I probably felt the best and the strongest about, highest conviction, was Generac. And that one just didn't work out as well as it should have. I'm thinking about bringing it back at some point. All right. And our last award for all-time performance. Sorry, guys, but I did actually manage to edge into this one too. And yes, that is me in a zoot suit on the right. I really had. I told Ken I'm going to just head for an island in the Caribbean. I'm taking the year off. It was a magnificent year. Chasing this group of people. You talk about trying to keep up with the people who pick the stocks around here, and we're going to actually go right into that. It is a team effort, and some people could turn this around and suggest things like, Mark, it's about time you started pulling your weight on the portfolio.
I did notice that's the first time on the list, Mark. So,
but it's a good one, and again, to be up there next to Cy, who has this patience and discipline, and sometimes things take time. It's a pretty heavy reminder about that. So thanks, Cy.
You're welcome, Mark.
All right, so Ken, I wasn't kidding about needing that space on the trophy mantle above the fireplace.
Mark, I have a comment from somebody in the audience that I just have to read to you.
Okay.
The comment is, "Sorry, Mark, you look like Pop on Pawn Stars." Okay.
Also known as the old man.
Old man. It's your friend Dwight. Okay.
Well, I should have used the picture with Wendy in it there. That might have helped quite a bit.
Might have helped quite a bit. Anything to take the eyes off the big yellow suit here. So.
No, that was a zoot suit for a 50th birthday party. a few years ago now. All right, moving on. We've killed enough time on this. Again, I mentioned it's a team effort. Here is the team effort. We as a collective group are beating the market by 5.7%. That's the number that you see graphed here. And we're actually up near 6%, pretty close to all-time highs, even though it's been a pretty tough market to tread for the last year or so. So again, as Ken was saying earlier, the relative return is simply comparing the rate of return for the portfolio, the tracking portfolio, versus matching investments into the Wilshire 5000, subtracting one from the other, you get that 5.7, and the whole idea is stay above that dotted red line if we can. And this number has been pushing up steadily. Would like to see that in the mid-50s as a longer-term thing. Any thoughts or comments?
Just a nice looking graph, Mark, and you're right. Let's keep everything that except for that brief period right there around year 11 where we dipped a whole percent below. We've done a really nice job of keeping things where they were supposed to be, even in very uncertain times.
Yeah, Ardelyx may have been somewhat to blame for some of that too. So the good with the bad. All right.
And also it's just a good reminder, while certainly bumping that accuracy up is always a good thing, but you don't have to be right all the time to beat the market.
Great point.
I mean, it's just a little over half, yet beats the market by going on 6%. And it's not the exact same number, but it's also just the reason that you can do it is what you said earlier about the 200 picks that lost money were offset by one pick.
Mm-hmm.
The upside is unlimited. The downside is limited. 0 is the downside. You lose everything, but it's still limited. Upside is not limited.
It's a great point. In fact, it leads us right into this one. Here's the top 20 positions in the portfolio by the value or percent of total assets. And there's that Microsoft position, which has basically absorbed all those losses. So, you've got basically another 400 positions that have gained that add up to something pretty nice. So the way you read this is basically this is to the repeats up there are the number of times it's been chosen either by a knight or damsel or the audience. We put $1,000 into something. So Microsoft, for example, has been selected 5 times. You see that here. $5,000 invested into Microsoft has become that. So you can decode the rest of that chart. And a lot of household names on there, a few that are a little bit less familiar. You can see that Ardelyx 10-time selection has actually bounced back pretty nicely. And that was reflected in those golden statues. But some pretty good stuff on there. Costco's a one-time selection. We like to point that out also. A one-time selection now worth $10,000. All right. Any comments or questions? We show the dashboard on the next slide. So,
well, only Mark that the 7th one down, EPAM Systems, gives us a great example of patience. When the war between Russia and Ukraine was started a year ago, EPAM took a huge hit because many of its workers and a lot of its infrastructure was located in Ukraine. And the immediate reaction from a large part of the people that held EPAM was to sell it. And it really, really went down, but it has since recovered. It's made sure that its workers are out of the Ukraine or in safe places to continue to do their job, and it's developed workspace outside of the area that it had traditionally worked in, and it continues to meet contracts. It continues to do business. Quite a successful company when it's all said and done. $7,000 that Cy put in on a very rigorous, patient way of doing things has turned now into $18,000. That's pretty decent return, no matter how you slice it. and it's just a poster child for patience and discipline when you're investing.
Along with a little information technology and consulting doesn't hurt either.
Yep.
All right. We mentioned hot seat stocks or challenge stocks that we may want to look at unloading. I don't think we really have any of that to do tonight. You can see that the portfolio is in pretty good shape. It's a little low on par. Ken's going to actually cover that in a minute, so we'll just kind of skip over this. The stocks that are in the sextant here is basically urging us to use the lowest par to look at those companies and challenge those. These are still in pretty good shape, though. You look at the par over here in the 4 to 5 range. That's nowhere near zero. And for most of these companies, we would want that to drive quite a bit further along before we would consider dumping them.
Mark, we have a hand in the air from Susan. And Susan, I'm going to unmute you. Susan, I can't unmute you. You're self-muted. So if you want to unmute yourself, you can ask your question. Susan Herman. You'll need to unmute yourself, though, Susan. Okay, I'm going to assume that was an inadvertent hand, and I'm going to take the hand down, and let's continue, Mark.
Okay, so we'll cover all the things that trigger selling considerations, not automatic sells, but selling considerations as they're kind of itemized up at the top there. But we really don't have that tonight, so.
Mark, if you could stay on that slide for just a moment, I'd love if Hugh manages to join us this evening, or if we can get some information from Hugh for our next roundtable. I'd love to have a little bit in-depth discussion about Regeneron and what its pipeline looks like, where it's going, and everything. I happen to own Regeneron in 2 clubs that I'm involved with. We sold a significant part of our Regeneron based on valuation at our last meeting for the Wolves, and we're considering whether or not we should be selling it in the other club, again, based on valuation. It seems like the sales growth has slowed considerably, and that, of course, moves right over to a very slow par then. And so I'd love to get somebody else's opinion about this company. There's a lot written, and a lot of it seems to be at odds with each other. There's not a uniform commentary on what's happening with Regeneron. I agree with you 100% that NVIDIA and Five Below with those growth rates probably belong in the portfolio. They should stay. And I agree that although you didn't say it, I'll say it. I think that when growth rates approach numbers like that, the analyst community tends to either become too bullish or too bearish on the companies. And right now, I don't think they've caught up with the possibilities of these 2 companies.
Fair enough. I mean, when a company can shut down in the middle of COVID and still be the best selection for the year by SI, pretty formidable company. All right, so we'll come back to that. I think Regeneron is in the current update batch, so it'll be interesting to rake that over the coals here in the next couple of days. So I'll send you a note on that.
Hugh is with us right now. If you'd like to just ask him the question.
Oh, okay. Has he been around to hear your commentary, or you just join us?
I don't know. I just noticed the message. Hugh, did you hear what I just asked the audience? By any means?
I did. Can you hear me okay?
Yes, we can.
Yeah.
We can hear you
Oh,
great.
yeah, perfect.
It's good to hear your voice, Hugh.
Yeah, thanks. It took a while to get in, but I'll look up, I'll dig into Regeneron in a bit more detail and maybe talk about it next month.
Great. Terrific.
That works for you?
Okay. Thanks a lot.
For those of you who may be new to what we do here, these Hugh McManus entries here for best all-time performance, that's the voice you just heard. So we kind of like to.
If you had a worst as well, I'd really feature on that one.
Thanks for joining us, Hugh. Let us know if there's anything on your mind.
Okay, just hair.
All right.
Sorry, Ken.
Time for pizza.
All right. I think I will. No, go back to that slide. I was
Oh,
going
you
to say,
like
I
you
think
like
we.
that one better?
Yes, I was going to say, I think we'll just leave this slide up and I'll do the whole presentation so that everyone gets very hungry and remembers, well, let's turn on the smell-o-vision and so forth.
I don't know, Cy, you better watch out or we'll have a Portillo's slide up here pretty quickly. So.
Well, I thought maybe that was the appetizer that Mark had for Portillo's, and now this. All right, let's go ahead and jump into Domino's. First of all, a confession. I lived in Ypsilanti, Michigan for several years while I was attending the University of Michigan.
A customer.
Yeah, so I have fond memories of school and pizza, and of course, Ypsilanti is where Domino's was founded. 60 some odd years ago, 63, I guess, years ago. So here's relatively up straight and parallel. One interesting thing about this slide, do notice that earnings, particularly lately, have grown somewhat faster than pre-tax profits, and you could see, but also a bit faster than sales. And that's partially, I won't get into that in great depth, but that's partially because of the nature of Domino's franchised business, as well as they're very highly leveraged because they're using other people's assets, other people's capital to make money off of. That's why if you take a look at the return on equity and the book value of the company, you'll actually see that, return on equity is NA. You can't calculate it because the company is actually negative return on equity. So I'll point that out, but understand that's their business model. It's not something to get alarmed about, particularly. Some of the analysts, in fact, are mentioning that now the company will may not be quite as profitable at using debt to finance share buybacks and the like, but they have more than enough cash flow to cover their debt and to continue to buy back shares. But you could see that Value Line is quite optimistic on the company, and those are online calculations, so that's after the recent drop in price to a 52-week low. Very good potential over the next 18 months, 65%. Now that's not annual, that's over the 18 months. But then look at that long-term annualized projection between 20 and 29% that Value Line is looking at. So we'll dig in deeper and see if Value Line is smoking something or if it's good. I was looking at just a repeat pick, and you've seen some of the good performance by one-time selections, and you've seen repeated selections that have done well, and so I was just screening by some of the lower, lesser picked stocks in the portfolio that had done well, and I was thinking a little bit about FedEx, and just used FedEx as a screening example, and you could see it's almost just a sweet spot screen that I did with a little bit higher quality, and this is what I came up with, and Domino's Pizza came up second, and I liked it better than FedEx and these other companies, so that's why we're presenting it tonight. Continue. Quick industry study and comparison. Domino's is quite high par, certainly the highest par for a good quality company. Next slide. In the restaurant industry, ranking by quality, you see that Wingstop is just nominally better, and of course, really those first five, from 92 to 98, no particular difference, and of course, virtually everything is household names. And if you want some credibility, remember Texas Roadhouse was one of the highest picks all time early on the leaderboard, although I did have to yield to Master Mark, the master of 2022. But restaurants can make money. Next slide. Domino's, the company, I think we all know it, pizza. And it's delivery, carry out, although actually we'll see a slide that comes close to that delivery, carry out, but actually in the latest report, the company has been trying to emphasize carry out a little bit more. And for the first time in many years, carry out actually accounted for more than half of their transactions, not more than half their revenues, but more than half their transactions. And then the key to Domino's is innovation and adaptability. Next slide. These are just some slides from actually their third quarter investors presentation, but it gives you a picture of who Domino's is. They're the #1 in global quick service restaurant. That's what QSR is. Pizza, they have almost 20,000 sales or companies, stores worldwide. They're also the #1 in the United States. And as I mentioned, they're heavily franchised, 98%. That 2% is kind of their laboratory stores where they test out products and concepts. Next slide. Here's a picture of what they're looking like. And you notice there's still quite a bit of the world that they are not in. And they're looking at, in one of the later slides, they'll give you some idea as to how much expansion they think they can do in internationally as well as domestically. Next slide. Here's just a picture of them, United States, how dominant they are, and of course what they are stressing in this particular slide, besides the fact that they are by far the largest pizza company in the United States, is that this gives them scale over a very fragmented market. The green figures, the 48, 41, and 52, those are all regional chains and independents. So a lot of companies there. Then you had the major chains that aggregate a little bit higher than Domino's, but Domino's is by far the largest market share for a major chain. Next slide. And here's just the market that they're playing in. An $81 billion QSR industry, and even larger, 120 billion. The growth in those areas I've highlighted there in green, low single digits in the US, mid single digits long-term internationally, even after the pandemic effects of 2020, and carry out and delivery are growing faster than dine-in restaurants. And again, notice the top 4 pizza companies in the United States only have 52% of the market. That's just, you saw that graphically on the previous slide. Next slide. And as I mentioned, 2 businesses running out of one brand, 1 store with 1 brand, delivery and carry out. And this was as of the end of 2021. But by the end of 2022, which they just reported, more than half of transactions were carry out. And that's intentional on their part. Domino's, one of the challenges they've been facing is finding delivery drivers, and the pay that is required to keep delivery drivers. And so they are trying to actively shift more business to carry out. Next slide. Yeah, it's the next slide that'll mention it. Domino's also, while they of course are very interested in the technology or in delivery, they've got technology that they're working there, an autonomous vehicle delivery. Of course, I think maybe you've seen the ads for their latest push to encourage drivers to want to drive for them and to stay using electric vehicles. So they still are playing in that area technologically, but then just trying to be very practical in serving their customer with apps and various platforms, from wearables to smart speakers, that you can order your pizza. Next slide. And I mentioned the shift to carry out, and you've perhaps seen the ads about tip yourself $3, or they will tip you $3 if you deliver your own pizza. In other words, if you carry it out, and this slide mentions that. Next slide. And here, the next 3 slides just give you a little bit of the history of the last 10 years through 2021 and how they did it. The global store count, that is the number of locations. And you see the tremendous international growth, somewhat slower United States growth, but 6.5%, a little over compound annual growth. And remember, retailers, to include restaurants, grow 2 ways. They grow by building more stores, and they grow by selling more in the individual stores. Next slide. This is that second way. It's a metric called same-store sales growth. That's how did stores open for, or in this case, restaurants open for more than 12 months do. And again, you see the average in the United States is 4%, and a little over 5% for international sales, same-store growth. So very strong same-store sales growth, and you add those 2 percentages together, the 6.6% plus an average of somewhere in the probably in this, given the weighting to international, close to 5, gives you close to an 11% growth rate that we'll see on the next slide. And there you go, right at 10% is how it has worked out over the years through 2021. And despite the challenges they're facing and a somewhat disappointing quarter, primarily on earnings, not so much on sales, in the fourth quarter of 2022, the company continued that growth rate into 2022. Next slide. And this is the slide I mentioned earlier that talks about potential growth. There they see 8,000 plus potential stores, and then you see a listing of what is it, about 8 international markets in developed countries and emerging markets. More growth, obviously, potential in the emerging markets because they're still breaking into those areas, but they see over 10,000 potential international store increases just in those markets. And there are, of course, Domino's currently is in 90 plus countries. So there's a lot of other potential growth out there. Next slide. Here's my judgments. The company and why it took a hit last week when it reported earnings was that they lowered their estimates for the next 2 to 3 years, down by about 2 percentage points, both on sale or store growth as well as revenue growth. I picked right about the middle of the analyst projections and the companies at 7%. That's down from historical. You saw it around 10%. Morningstar specifically commented, while they lowered their revenue projections a little bit based on company guidance, they did not change their valuation because they thought the company could still continue to grow earnings or increase earnings at a good pace. And they basically, their comment was that the challenges with higher construction costs, higher interest rates, financing costs, as well as just some questionable economic environment. Says that's being faced by all restaurants, and Morningstar direct quote is those costs should drive a medium-term contraction in unit development for most operators. Domino's is simply the first company to publicly admit it. So it's an overblown concern by the market, which can, of course, give us opportunity to buy. Next slide. And here's, whoops, that is an error. That's from last month. Let's go to the next slide. I was going to say, we're not doing worst case in this one. Here we go. Here's your bottom line using a high PE of 30, which is down a good bit from the historical high PE to account for slowing growth. You get a good solid rate of return of 16.3% using the average PE of 25, a little over 12%. And of course, both of those have much potential upside because the manifest consensus par based on the average PE is 20.5%.
Okay. Thanks, Si.
Hi, this is Herb.
Yes, Herb.
Do you know what it would cost for a franchise for a Domino Pizza, both locally and worldwide?
I'm sorry, I do not know the answer to that question, but I'll see if I can find out for you, Herb.
And then the other thing is, just to let you know, Tom Monahan, who started Domino's Pizza, grew up in Traverse City.
Oh, okay. I did not know that. He bought the Tigers about the time I left town, but I did not know he grew up in Traverse City.
Cool. Thanks, guys. All right, just a quick reminder that we do have, Ken and I will be at the AAI March 21st in Troy. That's in-person meeting, and we're just going to share some thoughts on investing for 90 minutes or so with the community of investors. So with that, Ken goes back to his one of his favorite banks, Western Alliance.
Patience and discipline, Mark. Patience and discipline.
The
last time I did Western Alliance was at the end of last year, so it was only 3 months ago. So let's look at it again. We have some new numbers, and we'll see where it's headed. I started my search for a stock for tonight by looking at the entire roundtable portfolio. My par, when I was looking, and that was this morning, was at 10.7%, which means the average stock in the Manifest Investing database had a par value of just under 11. That's pretty much market average over the last 50 or 75 years. And with that, that makes the sweet spot. If you're going to beat the market by 5 points, that brings the bottom of the sweet spot to 15.7. Nicholson made it quite clear that doing anything better than 10 was a fool's errand. It was very difficult and nigh on to impossible in many cases. So we capped the top of the sweet spot at 10 above the average, and there's your 5-point sweet spot, 15.7 to 27. Our portfolio is at 12.9. That's 2.2 points above where the average is. That's darn good. If you can maintain your portfolio that many points above the average over long periods of time, you have a significant advantage. But this is a demonstration, and we'd like to push this portfolio to 5 above if we could. Quality in the portfolio is great. These are all weighted average, and that growth number, that's sales growth, that's sticking pretty much where I like to see it. I like to see it between 11.5 and 13. Some folks would tell you that might be pushing it just a touch. It is possible to be so concerned about sales that you get your portfolio full of a lot of risk besides a lot of other things, and that's counterproductive. But I think we're in pretty good shape. Financial strength and EPS stability, I'm looking at them in the mid 70s to high 70s, nothing to worry about. So I'm looking for a stock with a par greater than 12.9 and with growth characteristics greater than 12.8. I find that in a well-managed portfolio, the growth number plus the yield tend to match the par. Now, that's by no means arithmetic that's going to work out exactly ever, but over time, the growth value plus the yield value tend to match the par value. So let's see what I found. Next slide. This is right from the portfolio itself, and I gravitated towards the middle, the top of the sweet spot and the very bottom of stocks that might be too good to take a look at. You see there's a lot of household names in there. We've done an awful lot of them before, and on that list was Western Alliance, that short list that I'm looking at. And when I kind of run my eye up and down the column for sales, that's the first boxed in set of data, I noticed that Western Alliance had the highest sales except for Google. Google, I liked Western Alliance a lot better than I liked Google at this particular moment. I looked over to the other side, and the par value was certainly above the par value for the entire portfolio. So I decided Western Alliance, which I knew a lot about already, was a stock that I could get behind. It's less than 1% of the portfolio. I don't begin to have trouble with any stock up until it gets up to be about 2.5, 3% of the portfolio. So Western Alliance it was. Next slide. Nothing should be automatic when you're looking at these portfolio management kind of things, however. And I did look at the bottom of the list as well, and I boxed those in. I came up, of course, with the same three stocks that Mark showed us earlier in the meeting, NVIDIA, Five Below, and Regeneron. And out of hand, I said that I just didn't want to get rid of those high growth stocks of NVIDIA and Five Below, but I did have serious questions about Regeneron, and in fact, I was going to move my questions up to include Lockheed Martin as well. Those two sales growths of 4.2 and 4 are a little bit concerning. They're quite low. Lockheed Martin is balanced a little bit by a yield, by a dividend of 2.6%, but Regeneron pays no dividend of any kind. I'm going back and forth, and I'm asking myself, could I have helped the portfolio by suggesting some sales as well? That's why I asked the question about Regeneron, and I think next month will be a time when we should take a serious look at this particular stock. Next slide. Here's Western Alliance after its 2022 report. I'm looking at assets before I look at anything else. That's the aqua line. And for a bank, it's an extremely important line, probably more important than the sales line even. I want to see assets growing at about the same rate as I'm seeing sales and earnings. So I'm looking down at the data and I see assets growing 10-year average at 24%, comparing that to EPS at 24.5 and sales at 22.4. the assets are performing the way I would expect. I also put those dots on there. That's Morningstar's opinion as to where the next 2 years might be. That's a 2-year sales call going forward of 19.6%. And they're not making a 5-year call. They've only given me 2 dots for the EPS detailed estimates, but I like to see where they fall against my own estimates. I noticed that the growth had slowed from 21 to 22 when I compare it to the growth from 13 to 19. So I slowed my growth just a touch in going forward, and I moved the growth sales down to 15 and the growth earnings down to 12. I'm trying to present an extremely conservative SSG and see where that takes me. Next slide. I knew a lot about this bank, but I went to its most current investor presentation. You can see many of the awards that it wins. It was interesting to see that in 2022, they won the award for Best CEO and Best CFO from Institutional Investor magazine. That's a real plus as far as I'm concerned. You're buying management as much as you're buying anything else when you buy a company. Lots of other awards and a really clearly defined, diversified business model. Next slide. Branches all over the place. They began as a very small, localized bank in southern Nevada, where that one dot is, and then they've been expanding ever since. Their primary banking focus is in the states with the kind of olive color background, but they are doing a lot of banking throughout the country, and you can see by the dots that while they don't necessarily have a lot of branches in a lot of these places, they do have places where you can do different types of financial services that are under the umbrella of Western Alliance. Next slide. Really diversified loans. They don't stick to just plain old mortgages. Really diversified by type of borrower when you take a look at them. And I like the figure in the bottom right-hand corner of this slide. The compounded annual growth rate of loans for Western Alliance is their loans are growing at 25+ percentage points. Compare that to their peers where the median growth rate is about 13 and the top quartile where the median growth rate's a little bit less than 15. This is certainly a bank where it's blood, it's lifeblood, and for any bank that's loans, where its lifeblood is growing at a really, really healthy rate. Next slide. Industry-leading profitability, you can see by a lot of different measures. I'm pulling just selected slides from a very well-done investor presentation. If you're interested in Western Alliance, I think it would behoove you to go into the website, look at their presentation, and look at some of the jargon, get to understand what some of the letters mean. We know, for example, that ROAA, that's the upper left-hand corner slide right there, is return on average assets. And that's one of the key statistics that our SSG helps us follow. Next slide. Here is that ROAA, including the 2022 fiscal year. The 5-year average is 185. The most recent is 169. The number becomes more significant when it has a history of repeating itself. And so I'm looking at my key down here, or my hints, and I'm saying to myself, an average bank about 0.85, a really good bank 1.25, anything above 1.5 is superb. And I'm looking all the way back to 2015, and I'm seeing numbers above 1.5. I'm going to expect them to bop and weave a little bit, to move up and down and in various directions, depending on other things. But if it can keep that number above 1.5, I think I'm looking at a superior bank. Next slide. Closing price on Monday night of $74.31. Compare that to $62 and change about 5 months ago. So it's had a pretty decent run in the last 4 or 5 months. When we put the 2022 numbers in, we get an average of 13.4 at the high side, 6.7 at the low side. I'm going to use 13 and 6 as my forward-looking PE values. Average PE of 10 with a current PE less than 8. The bank is undervalued. I like that concept. Next slide. Projected return with the numbers I've chosen of 18.5% at the average PE, 25+% at the high PE. And I feel that that number is matching or coming close enough to the value from Manifest of 17.2 that I'm getting validation. So it takes patience to develop a holding in a large portfolio. I'd like to get this bank up to around 1.25, 1.5% of the portfolio. So my suggestion is we add another $1,000 in Western Alliance Bank to this portfolio.
Thanks, Ken. All right, I'll wrap us up tonight. I'm going to talk about a 100 Club. This is something that, Ken, you may recall you actually liked this a few months ago. And I think we'll make it a little bit more of a regular feature. It's not 100 companies. It's actually about a dozen, maybe 14. But they are the companies that have the best combination of return forecast, projected annual return, and quality at Manifest. So forget what Ken told you about the company that I selected because it was supposed to be a secret.
Okay.
Here's what, forget the company, forget the industry it's in and everything else, and just look at this. I mean, this is a good looking company. Pretty much up straight and parallel. You can see that the earnings have been a little bit bobbing and weaving, but certainly headed in the right direction in general. We see that there was something of a price disturbance in 2020 and 2021. The sales growth trend is pretty clear. It's clicking in right at about 7%, plus or minus. So that's our first takeaway. We're kind of curious about what did that price excursion look like, and sure, it had everything to do with COVID. That's what you're seeing right here. Basically, this COVID moment here, along with quite an effective come out of COVID. We also see this right here. You know, kind of Wall Street soured on the company for a while, so we want to keep that in mind, what was going on there. And it has recently come back down, actually coming down from the $200 price range to the 120s fairly recently. All right, so taking a closer look at the return calculation, we have that 7% sales growth forecast. Second component of a return calculation is the projected net margin. I think that 11 is pretty easy to warm up to based on what you see right here. And it's not science fiction to see that. The one thing that I would point out, that period of price stagnation that we saw from 16 through 19, I think that's probably the cause. The Wall Street rhinos were probably looking at it, seeing a bit of stagnation in profitability, perhaps some concerns about operational challenges, and that was reflected in the stock price. This stuff here is just symptomatic of some of the companies that came out of COVID, all gangbusters, and have benefited from inflation and being able to charge higher prices, all that kind of stuff. That basically wrecks these PE ratios down here. The PE ratio for the future that seems to make sense, low teens. I think this is something that is definitely viable. So we get a projected return of approximately 18% based on those three assumptions. So here's a quick look at the quality over time. It may be sagging a little bit, but definitely still in the quality range. I think when we get a few more of those years in here, this will look much better. The thing that we do like to always notice is that the return forecast is near long-term highs. So it's a better value than it's been in many years. This company, this secret company that we're looking at here. Here's the audit on that projected annual return known as the projected return on value. You heard Ken talk about that in during the golden statues ceremony. The big number here is this one. Again, the projected operating margin, a lot like the pre-tax profit. Again, that period that Wall Street seemed concerned about is shown right there. You can see that recent years have been strong, and they're projected to stay fairly strong. It would be easy to imagine this company in the upper to mid-teens going forward. If that were to happen, based on those assumptions from the other page, you're looking at a projected return on value, which actually matches up fairly well with the projected annual return. So I'm pretty comfortable with a 13 or a 14 PE is what it basically says to me. Some other things about the company: the current stock price is at 124. The buy below is at 139, so we meet that criteria. And the company has no debt, no long-term debt. So that's cool. All right. Some other features that are fairly attractive. This is one of Hugh McManus's favorites. He likes to see the position in the 52-week price range less than 20%. So that actually has snuck down to where it's reasonably close to the 52-week low. That is a risk mitigation strategy that we follow. The value line low total return forecast is up in double digits. And I find these two numbers pretty compelling. These guys do tend to get overly optimistic from time to time, but both Morningstar and the analyst consensus that track the company have them at a significant undervalue, probably too good to be true, but those are compelling numbers. So here are the companies that are in that 14-member list. There's some pretty good studies on here, guys. Taiwan Semi was just sold by Berkshire Hathaway, but long-term picture is kind of compelling. Green Brick Partners, one of Matt Spielman's favorites. Meritage, perhaps a head-to-head battle there. A lot of chip companies on here, but you can see Williams-Sonoma checking in down here, middle of the chart. Pretty good numbers across the board. By the way, this last column on the right is a dramatic display of when the rhinos, the Wall Street analysts, are talking recession, what they allow themselves to see for sales for the coming year versus the most recently completed year. You see some, I should make that red ink, probably can, but a whole bunch of negative numbers there. So they're actually looking for downdrafts in a lot of these companies. We'll see if that actually happens. They tend to get a little bit crazy. So it was supposed to be a secret company, but here's the company. Pretty well known by the audience. It's been in the better investing community for many years. I wasn't aware that Pottery Barn was by far their largest component when it comes to an operating segment. But Williams-Sonoma, home, and the quality products for food, cooks, and entertainers. I know that Ken's ears perk up, so do Kurt's and size when it comes to rampaging in the kitchen. I'm not quite what they're up to there, but good stuff across the board. They've just got some good brands, not a lot of surprises. I did pull out the Morningstar. I hadn't done this in a while. When I was an active member of an investment club a few years ago, if I wanted to convince the club to buy the stock, I would just read the Bulls side. If I wanted to vote against something proposed by somebody else in the investment club, I would pull out the Bear side and read that, and without reading the Bulls side. But in this case, let's be balanced and consider both sides. The attraction here is that this company has performed pretty well, even with cyclicality in the economy. And they're pointing to just pretty steady sources of stuff. They are carefully expanding into some other markets. These are all good things. And notice that they mention e-commerce. These are all pretty cool. China is a constant. Disruptions from China, that's not news. That's dog bites man type stuff. the housing market, the real estate market is a valid concern. And this third one down here, this is always true, and it's true for everybody in the segment. I think this is the sort of thing you do when you figure out you got to have a third item to put on here. That just says it's a jungle out there. It's tough to run a retail business. So the things that we'd be most concerned about here are any potential weakness with respect to the real estate or housing market, or what about this online stuff? I was a bit stunned. A big portion of their business comes from online. They're in the top 25 e-commerce retailers out there, and they've been making steady progress. In fact, these numbers here have a lot to do with some of that profitability surge that happened in those time frames. It appears to be quite sustainable. And every time I turn around, I'm ordering more pillows and carpet inserts and stuff that I don't know about that just show up on my doorstep. So I know this is a valid area of business, and they seem to be doing it well. One last thing that I would like to just kind of kick around for just a moment. Y-Charts has added this thing called stress tests for a lot of the companies that they cover. And what they basically are doing is taking a look at the company's stock price performance during incidents or challenges. And in this case, last year was a tough year. They're referring to it as the inflation drawdown. And the stuff in purple is what Williams-Sonoma actually did. The stuff in orange is versus the S&P 500. So you can see they actually held up fairly well for a retailer versus that, what they're calling an inflation drawdown. Again, going back to that surge in business that we talked about just a few slides ago, those bumps, these bumps that are in the middle of the page here, those are shown fairly dramatically by what happened to this company during the coronavirus crisis. So again, when the coronavirus crisis hit in the spring of that year, they took a bit of a dive, but look at the recovery and look at how they behaved coming out of that, much like Lynch's Five Below, coming out of the coronavirus challenge and doing pretty well. And last but not least, how did this company actually behave during the real estate crisis of 2006 through 2010? And you can see it actually held up pretty well. In fact, you could make the argument that we're somewhere in here. I don't know where we're at, but some of the housing indications have actually started to improve a little bit. If that's the case, a company like Williams-Sonoma has shown the propensity or the capability to actually outperform coming out of that type of situation. So it's kind of an interesting piece of information. I think years ago when I was trying to talk my investment club into Clayton Homes, and they say, yeah, but what if a recession hits? If I could have pulled up, the last recession and looked at it in this context, I probably could have convinced them, because Jim Clayton said, hey, we do it just fine during a recession, and we should have been able to show that. And I think that's just an example of being able to look at the big picture and the total situation. So I like this company. It's one of Susan Zabinski's favorite picks over at Morningstar. So you're looking at a situation, steady quality, high returns relative to history, pretty much up straight and parallel along, following along with the COVID bump and chasm that went along. And I like this company to add to the portfolio. My mystery company that Ken blew the cover of.
Well, you didn't tell me.
Yeah, I guess I should have. I thought maybe those question marks would clue you in. All right, we can go to our poll now.
And here's our poll. It's open for you to vote. Pick one of the three that we've presented, or pick none of the above. We'd love to have around 80 or 90% of you voting. We're up to 65% voting right now.
Are we getting any write-in votes for Portillo's?
No write-in votes of any kind, Mark, okay? All right. It doesn't cost anything. We just need you to take your mouse or your finger if you have a touch screen and choose which one you think you would like. I'm going to count to 10 backwards in my mind because we just hit 80% voting.
Even if you're with us for the first time, vote early, vote often.
And I'm going to close the poll and share the results.
Let me guess. I can't see the poll, so I'm guessing that
Western Alliance has 50% of the votes.
Of course it did.
Domino's Pizza has 25% of the votes. Williams-Sonoma has 17, and 8% of our folks that were voting felt that they didn't like any of those to add to the portfolio this time. So let's hide that poll and move on to the next slide, Mark.
Probably just goes to show that if we put 2 retail stocks and a financial sector stock up, we're going to get some none of the above votes from this audience. That's just Mark's theory for the moment. All right, here's our reminder that if you go to YouTube and you just search on Manifest Investing or Roundtable, you will be taken to this collection of bull sessions and roundtables. Some of the successful investing series is also there. We'd encourage you to hit subscribe, and we'll let you know anytime that new content is added. We would greatly appreciate that.
Mark, I'm going to address a couple of questions here before we leave the thing. We're getting a lot of questions about why we don't publicize the names of the companies much earlier than we do, and why we're not posting copies of slides for you to download at your leisure and everything else. You must understand, folks, that this is a volunteer-run program. This is run by the Mid-Michigan chapter. It's not a program coming from Better Investing home office, and sometimes our deadlines are pretty tight. To be honest with you, I think we feel very lucky when we get all of our material together and in a form to present by 6:30 or 7 o'clock on the evening of a presentation. We do offer you all the slides. All you have to do is drop a note to Mark at manifestinvesting.com. That's Mark, M-A-R-K, at manifestinvesting.com, and he will send you a copy of the slides tomorrow sometime, and we'll also post them for you to take a look at and to do what you will on the YouTube channel. But we just don't have any paid staff, and we do this as I said before, it's a labor of love. We enjoy doing it. We enjoy sharing with you, but this is done completely with volunteers, and you have to cut us a break sometimes on the way to getting everything up and running. Mark, we pretty well covered the questions. I want to thank
I've
the
also
other.
been known to make that selection on about 7 o'clock on the day of the meeting.
Well, I didn't say that, Mark, but I didn't want to say that, but sometimes we're still making up our minds at 6:30
I think I
or
may have
7
dropped
o'clock.
out. You still have me, Ken?
I still have you, Mark. We're still there. I want to thank the guys that helped answer questions in the background here, and I think we've kept up to date pretty well. The only person we'll consider that. Anything else to add for the good of the cause, Mark?
I'm not Mark, but in answer to Herb's question, and just for the 25% of you who think that we should own some stock in Domino's, if you want a franchise, the franchise fee is $25,000 to get into Domino's. Now, you're going
that seems fairly low. Is that low?
Franchise fee? It is. Now you're going to need somewhere in the six.
Okay. Mark, are you still with us, or did we lose you?
I dropped out. I'm back now though.
There you are. Okay, great. Do you have anything else to add? We have the coming attractions up here. We're starting to take invitations from chapters throughout our part of the country. If your chapter would like to have a visit, we are going to be in Cincinnati on the 29th of April. I'm going to be down in Atlanta on August 19th. On November 4th, Mark and I together are going to be in New Orleans. And the convention, the NAIC Better Investing Convention, will be virtual this year on 2 different days, on the 3rd and the 10th. I know Cy will be at the convention. I will be presenting at the convention. And I don't know if they've worked out their entire list. Mark and Cy and I will certainly be serving on a stock panel. And we hope to get a lot of you at a lot of the things we're going to be doing. That session in Tampa is Mark by himself on April 1st. If you need information on any of the events that we're putting on around the state here, drop an email to either Mark or to myself, and we'll certainly get you registration materials. With all that, I want to wish the guys in the back room a hearty thank you, especially to Cy and to Hugh and to Mark. If you would have told me 13 years ago that we were still doing this, I would have probably laughed. Okay, but here we are 13 years later, still having a fairly decent time putting together some great ideas for our community, and let's see if we can get it going for another couple of years at least. Okay,
and
thank you so much, guys.
You're most welcome. And to think your initial response was no costumes.
It's still my response, Mark.
Good stuff,
all right,
guys.
thanks everybody. Good night.
Good night, everyone.
Good night, everybody.